But let's discuss the urban consumption trend, and especially after Jubilant Foodworks blockbuster same-store sales growth data that got the stock rallying and then saw some profit-taking coming in. Let's now take a look at how FMCG companies have delivered their Q4 numbers and how have they done so far. Mubina has been number crunching and analyzing and comparing all that data. Mubina, how do these companies stack out?
Well, not bad so far. You know, we have just about 5 odd companies that have come out with their numbers in the FMCG space. Of course, the bigger boys like HUL, ITC are still pending. But for now, the numbers look pretty good. If I have to look at a Dabur, an Imami or a Godrej Consumer, they have come in line with expectations. Jubilant Foodworks, of course, like you as well mentioned, it was a blockbuster set of numbers. Only Marico has actually disappointed a bit. If we look at volume growth, which is, of course, the key parameter on the back of which essentially, you know, viewers, rather investors do judge on FMCG companies, numbers. Again, in line with expectations. Imami has done very well, which did turn out to be a positive surprise. 9% was the volume growth that they delivered versus 5 to 7% of an expectation. Marico, on the flip side, was a big shocker. Volume degrowth of 1% versus expectations of about 5%. Godrej Consumer in line, and Jubilant Food, of course, we know the story. More than 26% same-store sales growth versus expectation of 20%. Sustainability of that is something that the management alluded to in the conference call as well, that they are going to work towards maintaining that same-store sales growth. But of course, that's a question that can be answered only when the subsequent quarter numbers come out. For now, like I said, we have HUL's numbers pending, we have ITC's numbers pending, Asian Paints, Britannia. These are the 4 guys, among the major ones, who still do have to come out with their numbers. And over there as well, that recovery trajectory of sorts, which you as well were talking about, is expected to continue. Remember, HUL for the longest time was stuck in this range of delivering volume growth between 0 to 4%. But the last 2 quarters, it has really been able to recover very smartly. So last quarter, we had HUL delivering double-digit volume growth. This time around, we are expecting it to come out with 8% volume growth. Asian Paints as well, that recovery trajectory will come by, and 8% volume growth is what's expected over there. So yes, that of course is the FMCG report card so far. It looks like a good set of numbers.
Right. We'll stay with FMCG, and FMCG is where the real action is, both in terms of volume growth, premiumization of category, and also some visibility in some of the rural penetrated categories. So we'll take that discussion forward. We've got Amish Agarwal, Senior Vice President. Senior Vice President, he represents the FMCG Research Department for Prabhudas Leeladhar, and Milind Sarvate, founder and CEO of Inrate Value Advisor. Now, Milind Sarvate, of course, was associated with Marico, so he has all the insights as to which way the entire hair care and so-called urban FMCG market is moving. Anish, let me start with you first. If I look at the broad trend for FMCG, it is positive, but within that there is a large divergence which is visible. Dabur volume growth numbers were strong. We never got a very encouraging feeler from Marico. Imami just about there, and Jubilant same store sales have been absolutely amazing. So why within FMCG there is such a large divergence?
You see, this diversion is based upon the company specific factors. There is one common thread which is there, that the overall demand is better, particularly if you look at one common thread, that the rural demand is growing faster. Whether it was Dabur, whether it was Imami, Marico, for every company, the rural demand has grown at a much faster rate than the urban demand. And rest the fluctuations which are there, they are based upon the factors which are specific to those companies. Yes, if you look at Jubilant, their same-store sales growth is 26.5%, which is a 6-year high, but that can't really be attributed only to the uptick in the urban demand. It is also to do with the various initiatives which have been taken by the company. Of course, the demand is improving, but I would say that the various, you can say the variations which are there are due to the company-specific factors.
When you say company-specific factors, within that also, do you think there is going to be a divergence? Do you think what Jubilant Foodworks has reported yesterday, Westlife is not likely to report? Do you think now the right way of looking at the FMCG category is that we should be company-specific rather than taking a view on the sector per se?
You see, I think it was always company-specific, because of the various stages in which the various product life cycles of the companies are, how the product pricing is there, and what sort of competitive intensity is there, it is always going to be that way only.
What to get you in on the discussion, considering you've been at the helm of manning an FMCG company, and a large one at that, in your erstwhile role. The growth posted by FMCG companies has been fairly good. You know, although once again the base quarter has been marred with noise of GST. How is it that you would view the underlying demand in the economy?
We have had too many disruptions in the past few quarters, starting with demonetization, then with the GST implementation, which actually was pretty impactful for the distribution business. Now we have elections coming up next year, and this year also in some key states there will be elections. But as you see in India, these things keep happening. So these disruptions apart, I feel that the fundamental demand generation seems to be coming back on track. So one would see higher growth from FMCG in the quarters to come.
Okay, so help us understand, where in which categories do you believe the pace of shift from organized to organized has been so, unorganized to organized rather, has been slower?
I can notice some categories where it is faster. In terms of slower, one will have to really get into details. But in foods, for example, the conversion from unorganized to organized has been pretty fast. In fact, the huge variety that we have in food, it encourages smaller entrepreneurs to float their own brands, and that has encouraged conversion from organized to unorganized to organized pretty fast. Branded services is also another area where the growth has been faster. I would say in categories which are dominated by larger players and where the penetration is already high, for example, detergents, toothpaste, and basic hair oils, etc. I feel the conversion from unorganized to organized has been a little slower than the rest of the category.
Amish, let's also consider the valuation which some of the FMCG companies currently are trading at. HUL at about 50-55 times, Jubilant FoodWorks 60 to 70 times, depending on the estimate you are looking at. So for an investor who's holding on to these stocks or is looking at buying these stocks, do you think they should not expect even single-digit returns in next 12 months, or growth can surprise you and P multiples will expand?
You see, FMCG sector, if you look at the last couple of decades, has seen two phases. One phase being, say, in the mid 90s to, you can say, 99, 2000, when the sectoral PEs were of the kind we are witnessing today, and then there was a crest, and now the P multiples have also come up. Now, if you look at particularly past 5-7 years, because there was very little growth happening in some of the other segments, and the consumption basket gave a steady growth, there has been a steady increase in the P multiple of the company. So at every level, it seems that the P multiples have peaked, but somehow when the performance comes, the markets have been giving a thumbs up and the P multiples have been moving up. But to be on the cautious side, I think from the viewpoint of fresh investment, one will make money only over a period of 3 to 5 years. One should take a medium term view. If you are taking, say, next 6 to 12 months view, because of the various uncertainties ahead, for example, we are yet to see which way monsoon goes, then elections are there next year, and for example, the oil prices are rising here, and for example, the oil prices are rising. So the outlook for fresh investment should be from the longer term viewpoint, because over the next 12 months you can make money, but there could be a period of lull where your stock prices can move sideways, because the P multiples are really high for most of the companies.
And you know, Amnish, really, that is the talking point, right? The growth is not something that, you know, that is questionable when it comes to these FMCG companies, but it's especially when it comes to the urban consumption plays, you know, your titans, and I'm, you know, spreading the umbrella a little beyond FMCG as well, a Titan, a Jubilant FoodWorks, a Page Industries, etc., etc. It's the valuations wherein the question mark lies. So do you believe that, especially when it comes to, say, a Jubilant, the valuation justifies the growth visibility?
You see, Jubilant FoodWorks is a very unique model in itself. if you look at even the global QSR companies, because globally these types of companies, they have moved more to a franchisee based model. Jubilant is having most of the stores which are operated by the company, so it has got high operating leverage. So in the times when your same store sales growth is, you can say, below your annual inflation in the overheads, your margins are under pressure. But now you are currently in a situation where you have taken all the corrective steps, you have undergone the pain, you have revamped your product portfolio, you have closed down lot of non-performing stores, and your same store sales growth are in high double digits. So it's like you can see the typical crest movement which is there for the company when your margins are expanding, your SSG is improving. However, I would say that we might see some first half is going to be very strong because the base is highly favorable. Post that, we might see some tapering off of growth for Jubilant FoodWorks, because in FY17 they added around 70 stores. Last year they have added 17 stores. So you can see the tailwind in FY19, FY20 sometimes will start to taper off, because the new store addition in the last 2 years has been on the slower side, but it should then pick up after FY20. So I would say that over the next 12 to 15 months, it should give you another 10-12% from here.
So closing comments from you. If you have to, let's say, buy 3 FMCG stocks or consumer staples, consumer durables, I'm using the overarching theme consumer here. Give me 3 stocks where you are reasonably confident of a 15 to 20% earnings growth. What happens to stock today, tomorrow, next week, this week, that could be technical, that could be sentiment, that could be fund activity. But ultimately, if your earnings growth are there and evaluations are reasonable, markets will reward them. That's what I've learned in last 15-20 years. So give me a list of 3 companies where you think there is visibility for earnings growth for next 3 to 5 years, and the cutoff point, let's put it 15%.
You see, in general, all the major staple companies, their profit growth should average around 15-16%. So there would be very few staple companies which can go beyond, say, 20% in terms of CAGR. If I can, you can say, cite any example, I think Britannia is one company where we are expecting growth to be, say, around 20% CAGR. Barring Britannia, I don't see any company giving you that kind of a number, because most of the companies are at lifetime high margins. You can say your durables and retail category, etc. Yes, there could be lot of companies where you would have, say, more than 20% CAGR. For example, Jubilant can have 20% CAGR definitely. Then your Titan, I would say, may touch that, but depending upon the way the base has grown, doesn't look likely that it can sustain 20% plus for a very long time. Maybe Page can have it, or some of the retail companies like your DMart, they can easily have this kind of a growth number.
Right. All right, gentlemen, appreciate your time. Thank you for joining us.